Folks, we have an urgent warning for every single Palantir investor out there. Unfortunately, Mr. Jim Cramer himself, the reverse Midas man who is undefeated, just said that Palantir cannot be stopped. This means we're going to the abyss. We're going down to the depths of hell, folks. This is just the beginning of a very, very tumultuous ride. Unfortunately, Jim Cramer never misses, so brace yourself, buckle up, because this is about to get wild. Now, jokes aside, he's not the only person to talk about Palantir, because today as well, Dan Ives, who is a very respected analyst and a guy who has been very right about Palantir, one of the only ones who got it right early, also one of the ones who got it right about Tesla early. I'm seeing a pattern here. So Mr. Dan Ives, one of the best analysts in the business, the guy who also called Palantir the Messi of AI, a reference from the world of soccer, and by the way, he was not wrong, just came out today on X posting that their price target, the Wedbush price target, is going up from $75 to $90 per share, a significant increase, which again, according to everything we've seen over the past 2 years, keeps Dan Ives ahead of the pack as far as his price target for Palantir. And he also says on that very same post on X that he sees Palantir as the next Oracle or the next Salesforce. Now, if you've been a part of my community over the past few years, shout out to the community. You can join right now on patreon.com/DomNash, get access to our Discord. If you've been watching my channel over the past few years, how many times did I compare Palantir to Salesforce? I always said that the floor for Palantir is Salesforce, a $200, $300 billion company with a business-to-business, B2B setup. Now, I think that Dan Ives is actually talking about the bottom of Palantir, not the top. And I'll show you in a second why. So Dan Ives is saying $90 per share. He's saying, hey, it's going to be either Oracle or Salesforce, somewhere in that region. That means that he's seeing the current share price of whatever day you're looking at this, but in the 70s, is very, very low. Currently, Palantir is trading at a market cap valuation of $175 billion. Shout out to the people who sold at $9, right? So $175 billion market cap. And the valuation of Salesforce is about $300 billion. The valuation of Oracle is about $500 billion. So basically, Dan Ives is telling you that he sees Palantir as 70 to 185% bigger than it is today based on what Oracle and Salesforce are as companies. He's not saying that they have the same business. He's not comparing them as far as the products they offer, but he's saying that the size is pretty much in the same ballpark. That means that he's saying that Palantir has the potential to go 70 to 185% from this point on, and I think he's talking about the bottom. Now, look, I know you all read the Peter Lynch books. You heard the lectures. I did as well. I'm a huge Peter Lynch fan. And Peter Lynch always says, when it comes to growth companies, the moment you want to sell a growth stock is when two things happen. The price to earnings gets absolutely out of whack. But the other thing is, when the analyst recommendations start to fly in and they're positive all of a sudden, it's again the moment where you want to consider selling. If the hype is getting stronger, the analysts are recommending, the PE is flying out of the stratosphere, this is the time to get out of Palantir, according to Peter Lynch. I think if Peter Lynch was asked this question and he was presented with the 360 price to earnings of Palantir and the massive, all of a sudden, recognition it's getting in mainstream media, Jim Cramer is a great example, he would say, hey, it's not a good time to own this stock. In fact, Palantir might be due for correction. In fact, it probably is. But as a long-term investor, I simply don't care, and neither should you. I'll explain in a second why. Because you see, in the case of Palantir, the PE ratio, the price-to-earnings ratio, it doesn't really tell you the whole story. It's very easy to analyze and disqualify a company based on a crazy PE like 360. I get it. It works very well with Excel spreadsheets when you have to qualify and disqualify hundreds and thousands of companies. But when you look under the hood of Palantir, you find a whole different story. And this is the part I want to emphasize in today's video. If you actually look at the forward PE of Palantir, it's still out of whack, but it's 150. Still very, very high, 5 times higher than NVIDIA, right? But a lot less wacky. And if you take a look this time next year at the forward PE of Palantir, it's going to be in the 80s. And then you look at it again, it's going to be in the 40s. Palantir is growing into its valuation, into its PE ratio, just like Tesla did, just like Nvidia did, just like all the leaders in the market did, because they will always be at a premium. If you want to buy something unique, something special, something that there's not a lot of there, you're going to pay a premium. That's just the way it is. Now, here's the thing. It ain't the only thing that will show you the path as far as Palantir. Look at the rule of 40. The rule of 40, by the way, is something we talked about on the Academy at patreon.com/TomNash. I teach people these things, and one of the systems we went over is the rule of 40. So according to the rule of 40, basically, if a company scores at this test 40, it is phenomenal. 35 is good, 30 is decent, anything below 30 is average, right? But the optimal score is 40, right? Basically, you look at two things. Number one, what is the growth percentage of your revenues? And number two, what is your free cash flow margin? In the case of Palantir, the free cash flow margin is insane. It is 38%. And the growth rate is currently 24% of revenues, which means that Palantir currently scores 62 on the rule of 40 test. That is phenomenal. One of the best in the world at that specific metric. Now, there's better companies at rule of 40. For example, Nvidia is probably in the 200s at this point. Who knows? But when it comes to companies that haven't gone through the $1 trillion valuation, like Nvidia, a normal company, which is still below $200 billion in market cap, a 62 rule of 40 is absolutely insane. If you continue looking a little bit further, it gets even more interesting. Look, the revenue growth is currently 24.5%, correct? So that means that every time the company puts out new earnings, the revenues are growing at 24% per year. At the same time, if you look at the operating expenses of the company are only growing at 7%, which means that the gap, which is currently not that big, between the $2.6 billion of revenue the company is generating every year and the $1.8 billion of expenses the company is spending each year to generate that revenue, that gap is getting wider and wider and wider every single year because the revenues are growing at 25%, the expenses only growing at 7%. So that gap is going to get bigger and bigger and bigger, and the company is going to get more and more profitable, and the PE ratio is going to get smaller and smaller. You can see this happening if all you do is look at the PE ratio and say, not for me. But if you only look under the hood, you're seeing that it's coming. You're seeing that the gap is about to close. All you need to do is have a little bit of skills and analyze these things a little bit more deeper than the standard mainstream media. Now, I haven't even spoken about the fact that the company has doubled its cash for the past 3 years, going from $2.5 billion to $5 billion almost on cash and virtually no debt, which again is another sign of how excellent Palantir is. And now we're getting to the interesting point. No, I'm going to flip the page here, literally. According to the scorecard of Stock MVP, which is a software I've built in order to help you analyze stocks on a daily, you can look at any stock and within 30 seconds know everything you need about that stock. It is insane. Stock-mvp.com. So according to Stock MVP's scorecard, we have a score from 0 to 100 to show you the quality of a company based on objective metrics. You can't game this. You can't manipulate this. You can't change the values like in an Excel DCF. This thing don't lie. And the highest score we had so far, I think, was Nvidia at 90 and maybe Meta at 90. Palantir just went over the 85 and got to 90 score. We can't manipulate it. We can't touch it. Palantir is now 90 on our scorecard. And the reason is because something huge just happened. Palantir, for the first time, is now more owned by institutional investors than retail investors. When we started doing this in 2021, 2022, the institutional shareholding of Palantir was 30%. It just went to 51%. Palantir is currently more owned by institutional investors than retail. The whole story about the retail running up the stock is just a bullshit lie to prevent you from doing what the institutionals have been doing for the past 2 years. For the past 2 years, the institutional investors, while spreading FUD about the company, were buying. They were buying at 30, at 40, at 50, at 60. They were buying at these prices while telling you that's expensive. Why? Because they're seeing the future. This company cannot be stopped. And for those who wonder about the test, the only reason Palantir isn't scoring 100 on this test is because the PE is just too high and they're losing all the score on PE. They have 0 on PE, obviously at 360. That's just normal. But revenue growth is 1. Margin is above 10%. Cash growing over the past 3 years. Assets more than liabilities. Cash to debt ratio, obviously more cash than debt. They don't have shorts that much, less than 5% short interest. Institutional ownership now over 50%. It is scalable, which means that the revenues are growing way faster than expenses. And since the going public date, which was somewhere in 2020, since the DPO, the stock rewarded its shareholders 700+%. At the same time, Snowflake, the darling of the stock market in 2022, the Warren Buffett investment, Snowflake is now down 31% since going public and currently scoring on our scorecard in Stock MVP 65 versus the 90 of Palantir. So I think, first of all, it's time to stop the comparisons between Palantir and Snowflake. I think Palantir has melted Snowflake. It's gone. It's gone. Forget about it. Palantir is in a whole new stratosphere. Not to mention the fact that Palantir's own founder and CEO for the past 20 years is still there and has no plans of going anywhere, while the Snowflake founder, Frank Slootman, has basically called it quits. And now we have a professional CEO, which is something I particularly don't like. Now, where do we go from here? I think the key moment will be definitely February 3rd. February 3rd, we have the earnings. Basically, everything boils down to what happens with the stock appreciation rights. To kind of cut the story short, essentially, a lot of analysts missed this when they gave out their estimates. It's going to hurt profitability, not cash flow-wise, but accounting-wise. And if that may be the case, maybe the stock tanks. Maybe the stock doesn't tank. Who knows? But if the stock decides to tank after earnings because of the SARS, if it doesn't match the expectations, so be it. Me and my community will do the same thing we did 2 weeks ago. 2 weeks ago, when the share dropped to 65, we bought and we doubled down because it was 20% below the 52-week high. And now the stock is back to 75. We've made a lot of money. If it drops again after earnings, we're going to make more money by investing when everybody's fearful. We are greedy when you guys are fearful. And we're going to do it again and again. No problem. We did it through the entire year of 2022. This doesn't scare us. A little bit of SARS. Bad joke. Look, the stock has been at $10 on September of 2020, then at $37 on February of 2021, then at $6 on May of 2022, and now it's at $75. We've been through the roller coaster. We've been through this whole mayhem. You can't scare us with a little bit of volatility. Now, if it goes down, we're just going to double down. Very, very simple. Now, let me show you a little bit of a math exercise here. If all you did is dollar cost average into Palantir since it went public, and essentially you did my method, which is not secret, dollar cost average through the entire 4.5-year period, and you double down when the stock dipped 20% below the 52-week high. If all you did was that, since the company went public back in 2020, let's say that your investment amount was $1,000 every month, and when you double down, it was $2,000. If you did that, 1,000 DCA, 2,000 on double down, since DPO to this present time, you would be holding about 6,000 shares of Palantir right now at a cost basis of $13. 13, yes, I said it correctly. Which means that you invest about $70,000 and now hold the position of about $500,000 in less than 5 years. Not bad at all. Especially given the fact that if the stock actually goes to $160, you're going to have $1 million worth of a position, even if you don't buy a single share going forward. If you just stop buying Palantir now and sit on this position of 6,000 shares and wait for it to go to 160, well, you're going to have $1 million in your portfolio with a cost basis of $70,000. Essentially by doing nothing except doing good research, saving more money so you can invest more, picking good companies, and holding for longer. That's it. That's the whole secret. That's the whole secret sauce right there. So I urge you to actually stop this bullshit, stop the baloney, stop the timing the market crap. And yes, I've been saying it again and again. People always ask me, well, Tom, how the hell did you get to 10,000 members on your Patreon and all you do is just repeat the same thing every single day? Let me ask you a question. When an NBA player goes and pays a coach to do the same drills again and again, to shoot the same ball from the same spot again and again and again, why do they do that? Why do they pay the coach to do that? Well, that's because they're getting better. Every time my students and I are getting better at this, I teach them. I basically make them forged out of metal, out of iron. These guys are not going to budge when things get tough. Now, there's also a lot of things that are going on that are more academic in nature. We teach you how to evaluate companies, how to do modeling, how to do certain aspects of company valuation. And I get that that seems like the more important part of this. I understand. But it's more often than not that people screw themselves out of a great position because of psychology, because of fear, because of misunderstanding of market dynamics. So I would even say that 60% of what we do is the mental and the emotional side. About 40% is the academic stuff of the formulas and the DCFs and all that stuff. But again, if you want to learn this, and if you want to join the 10,000 people that have revolutionized their life since joining my program, patreon.com/Tom Nash. Would love to see you there. And just to let you know that on February 1st, we're going to shut down the academy indefinitely because we're just too full right now with 10,000 people. We're going to focus on the students we have. So this is your last chance to join for a while. Until February 1st, I'll see you there. Peace.